Tax treatment of cars. We need cars for our business and we want cars for our private lives. So how are they taxed? It really depends on how you structure your business and the sort of car you want. So it's probably worth going through in a little bit more detail, item by item. There's a huge amount of tax law on company cars, and in many ways the accountants and the tax authorities have been playing a cat and mouse game for many years, where the accountants are trying to think of loopholes and the revenue are trying to close down on them all. So there aren't very many loopholes left is the answer. So it is a very highly regulated environment that we're in when we're talking about company cars. So, you know, if you think of a simple workaround, then it probably doesn't work. And for example, a company car is defined as a car where you travel as much as 1 mile in it in a year. So it is really quite tight. So first of all, the structure of your business matters. If you're in an LLP, a limited liability partnership, or a normal partnership, or you're a sole trader, the tax treatment is quite different to if you're a limited company. So first of all, the sole trader side of it. If you're a sole trader, the way it's treated is there's a proportionality. So you work out all the costs of the car, you work out the percentage of the miles that you do in your business and the percentage of the miles that you do privately, and then you're taxed on the private percentage. So generally that's quite a good way of doing it, because a lot of people, they do an awful lot of business miles, they don't do very many private miles, therefore the tax effect, the tax cost of the car is actually relatively low. That is particularly relevant if you've got an expensive car, because all the other tax treatment, the car gets more expensive for tax and more expensive as a percentage of the cost as the car increases in value. Whereas if you're in a sole trader, it's simple proportionality. So it's quite a generous system, if you like. If you're in a limited company, it is quite different. And if you're in a limited company, you're a director of a limited company, and it is treated as a benefit in kind. And if you have a company car, you're taxed on a percentage of the new value, and that percentage depends on the carbon dioxide emissions. And basically a big expensive car gets taxed very much more heavily than a small one with very low CO2 emissions. Within a limited company, there are a few things that really can change the economics of how you hold the car. If you do very high private mileage, then it can very often be a sensible thing to have the car in the company. Or if you do a very high mileage, and therefore you're going to have to replace your car pretty frequently. So, but those are generally fairly rare, because when I'm talking about high mileage, I'm talking about really high mileage. The way that it works is that if you've got a normal mileage and a normal car, you're generally better off not having the car in the company. You're better off owning it privately, because the tax is less. There are some exceptions to that. So it depends whether you have a car, you have an electric car, or you have a commercial vehicle. Now, a lot of people have commercial vehicles in their company. The commercial vehicle tax treatment is quite different to the company car tax treatment, and it's sort of taxed in a similar way to any other commercial vehicle, whether it's an HGV or anything else like that. There is a small tax charge, but the tax treatment as a benefit in kind of commercial vehicles is very low, and you might also be able to claim the VAT back. So in terms of tax, commercial vehicles can be really good, but the problem is that people sometimes do that and then they decide actually they don't really want to be driving a pickup truck at the weekend, so then they sort of go off the idea. But whether you decide it is a commercial vehicle or not, there's actually a list on the Revenue website, and you can check whether your vehicle is a commercial vehicle or not, and we can do that for you if you'd like. But in truth, the people who are selling the vehicle will know, because it's very relevant to their sales process. The other good type of car from a tax point of view is an electric car or something that's very, very efficient in terms of its emissions, because there are certain grants you've been able to get. There's a very low benefit in kind charge, and also it is possible to get very good treatment for tax in the first year. So that with very, very fuel efficient cars, then it can be good. But then, if you're doing a big company mileage, you're going up and down the motorway, having an electric car might not be what you want. So there are practical considerations. And again, just as do you want to drive a pickup truck at the weekend, do you want to have an electric car? And that's a personal preference. So overall, if you've got a partnership, a limited liability partnership, or you're a sole trader, very often having the car in your business can be really good. If you're in a company, have a normal car, then normally you want the car outside the company and then just claim a mileage, and normally you'll be better off. Now, for everybody, their circumstances and the exact calculations are different and are personal. Therefore, to check what's right for you, it's the best thing to do is to talk to us, discuss your exactly what you want and exactly what you do, and then we can just see how all the rules work for you. But as I say, in general, if you're in a limited company and you've got a normal car, you're better with a car outside the company. If you're in any doubt, please get in touch. It's quite a complicated area, and it is very personal to you, and it depends on quite a lot of different factors that are very personal to you. So we can check what is right for you in your personal circumstances. Thank you for watching. If you like these videos, please subscribe, like, share, and comment on them. Thank you for watching.